solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome and great Monday morning to everybody. Hey, glad you're here today. You know, we're talking about the one big, beautiful bill and some of the impacts it would have, for you, not just for your 2025 tax return, but your 2026 tax return and going forward. Hey, if you're a trucker and you're an owner operator out there, you know, one of the biggest things, I mean, you're feeling it right now with fuel prices going up and freight costs still staying down. You got to be finding every way to cut your expenses, which part of those expenses, is taxes. And it's a large portion of your expenses. And if you're an owner operator, sole proprietor, even out there, you know that your bottom line of your Schedule C is going to be taxed at 15.3%. So you got to be finding every deduction, possible out there and ways to save valuable money on, for your business. And then it starts, finding ways to save money on taxes. And, we talk at Truck to Success with OOIDA and the foundation there, and we talk about bookkeeping, taxes, and finding those items that you're paying for after-tax dollars and moving them to pre-tax dollars. So expenses that, you should be running through the business that you're not running through the business, and, making them pre-tax, meaning you're spending money before you pay the tax. Because when you're spending it after, you're using that money that's already been taxed for Social Security, Medicare, and federal and state income taxes. But this is, the same thing we discuss with all small businesses out there, is finding those expenses. Find them. Those expenses that belong in the business that you're paying, maybe out of your personal, maybe you're paying with cash, maybe you run them on a personal credit card, and they're not getting captured in your business. Finding those expenses and making those expenses a business expense paid with pre-tax money. So it saves you money. Hey, talking one big, beautiful bill. And I've seen the news reports out there. Oh, it doesn't impact us very much. Oh, it's not as much savings as, it was billed to be. Oh, hey, there's things wrong with it. Hey, there's just things wrong with every bill. When you got Congress out there meddling and changing things, not even authorizing funding for, TSA, and you got long lines. So, they're causing the problem. And, it happens to be one party that's doing it right now. But, in this one big, beautiful bill, there were a lot of great things that help everyday people. Now, when you've heard the hosts and you heard talk radio, you've heard your TV station talking about overtime. Now, when they said, hey, overtime wasn't going to be taxed, everybody was thinking every dollar of overtime wasn't going to be taxed. But that is not the way this was ever working. People didn't read the bill to completely understand what they were saying in this bill for overtime. All they were really saying was the money they were paying you, not your regular hourly rate, the overtime portion, the half portion. So when they pay you time and a half or they pay you double time, the half portion, the double time portion would be not taxed. So, people were
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler. We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler. We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no-obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler. We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools at 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler. We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler. We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler. We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no-obligation consultation. We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools at 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
All right. Well, that was fun and exciting. Um, had a big power surge here, and I guess somebody didn't like me talking about the one big, beautiful bill and the effects of this one big, beautiful bill of overtime. So if all of a sudden we go offline again, it's definitely because they don't want me talking about the one big, beautiful bill act, Trump's. Additional tax cuts for everyday Americans. So, we're going to keep playing this by ear and seeing what happens. The internet here at our office is down, so we're kind of doing this by phone and doing this, right off the top of my head with a little bit of notes and everything. So what are, we were talking about overtime and the impact from overtime. So in 2025 on your W-2, they actually, the Congress is they, did not impose rules on how the employer was going to identify the amount of overtime that you worked. So in 2026, IRS has come out with rules and how the W-2 is going to be laid out to identify the overtime amount. Now, for 2025, the way you need to figure out your overtime is to go to your last paycheck stub, pull that, and it should have total of overtime worked for the year. And then it should be able to compute that amount that was paid for overtime as, the function of those numbers to get down to the deductible portion of that. So they're kind of going on a good faith system as opposed to having it laid out on the W-2. We've gotten many questions on it. We got questions on it back in January when the W-2s first came out. And, we were expecting to see most employers lay it out for their employees, but then the IRS came back in and said, there's no requirement for it, no place for it. So therefore, use your last paycheck stub to get to the right dollar amount. So it's a good faith thing. Go in, figure it out, make sure you got the support for it with your last paycheck stub. Now, what else did this one big, beautiful bill do? It added charitable deductions for non-itemizers. So this is going to be an adjustment to your adjusted gross income, even if you don't itemize. Beginning in 2026, this year, all taxpayers claiming the standard deduction will be able to deduct up to $1,000 or $2,000 if you're a couple filing jointly of charitable contributions. Now, that is really nice. I mean, many people do make charitable contributions. They contribute to their churches, maybe Red Cross or, Goodwill or whatever else they're going to be giving money to. And you're now able to, even if you're claiming the standard deduction, get that extra $1,000 or $2,000 deduction for your charitable contributions. Now, it's actually got to be made in cash, check, credit card to a qualified charity. So non-cash giving does not count. So giving clothes or something else to Goodwill doesn't count. But if you write them a check, you pay it in cash or credit card, and it's a qualified charity, then that will count and does count. So you get that added benefit right on top of your standard deduction. It's very hard, when the standard deduction is so high, it's really hard for many taxpayers to qualify to take anything other than the standard deduction, unless you're paying a lot in mortgage interest or a lot in property taxes. To get you above, that standard deduction becomes a big hurdle. So getting this extra 1,000 or 2,000 if you're filing jointly is huge relief for many, many people. So, you want to make sure that, you have got every avenue covered and every deduction that you can utilize. And that is one of those very good things for everyday taxpayers. Now, they did put some limitations on charitable contributions. So if you're itemizing, and you're going through and itemizing your tax return, you're not going to benefit tax-wise from making charitable contributions until the amount of the donation exceeds 0.5% of your adjusted gross income. So they think because you are itemizing, now you're rich and they want to tax you. And so they're going to put in that 0.5% that you've got to exceed your adjusted gross income before you can start taking charitable contributions. So it's going to have an impact on those that will itemize. People that usually have larger mortgages and larger state and local taxes, including property taxes, it becomes a little bit more expensive from that route as we go. So you're going to be on the lookout for those things just to make sure that if you can qualify, then you're going to have those limitations on those itemized deductions based on the fact that you're actually itemizing. So you got to be aware of those things that they're going through and doing. Now, they're also doing some income phase outs, and those income phase outs are going to be on the qualified business income deduction. Now, this deduction is a really good deduction for small businesses. And this deduction allows you to deduct up to 20% of your net business income from taxation. So, you need to be aware of those things and making sure that you're utilizing those deductions. I'm kind of multitasking here because I'm trying to get it back up to where I don't have to hold a phone and we can get back into the studio. So it actually looks like my system is back up. So what I'm going to do is we're going to take a short break, and I'm going to try to transition back over to my studio microphone and camera, and so we can be here a little bit better with you rather than me trying to be sitting here holding my phone and moving around. So we're going to be right back after the short break.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for you. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler. We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You.
Well, I don't know if it worked or didn't work, which one I'm on. So,
computer is on.
Okay. Very good. So anyway, we're on back, maybe working full time. We were transitioning over and all of a sudden it became unstable again. But hey, we're here talking taxes and not my internet problems and stuff like that. It's just going to be one of those really weird shows that we have out there. We're talking about qualified business income deduction. Hey, it goes for small businesses, it goes for larger businesses, but it's on your personal tax return. So if you are getting a K-1 from businesses, maybe that you own or have partial ownership in, if you got Schedule C, all this comes into play for the qualified business income deduction. Now, this original deduction started in the 2017 Trump tax cuts and then was extended in the one big beautiful bill. It was something that was going to be phased out and go away, and talk about a huge impact to small business people. It would have been a definitely a impact that everybody would have felt, and it would have been really tough to basically recover from as a small business owner. Beginning in 2026, income phase outs have been increased to benefit you, the business owner, claiming the deduction. So for single filers, the income range for the phase out is $75,000, beginning at a taxable income threshold of $201,000 and ending at $276,000. And then for married couples, the income range is $150,000, beginning at taxable income threshold of $403,000 to $553,000. And for comparison, these ranges were $50,000 and $100,000 in 2025. So this means as you earn more, you'll have less fear of losing this qualified business income deduction. So this is a really a good thing. They also put some minimums in that affected 2025 and 26 and going forward. So even if you don't have enough money to get the full qualified business income deduction, you have some limited deductibility based on the fact that you made at least a minimum amount of money out there. So that's a good thing. They also, in this one big beautiful bill, enhanced tax benefits for dependent care. So through employer-sponsored programs, taxpayers can elect pre-tax salary deferrals into a dependent care flexible spending account to pay for qualified dependent care expenses. Now, I don't have any young kids, and I know dependent care. We had Mother's Day Out program and other programs we had our kids in. It was really expensive, and that was way back when, 20 years ago. I've seen what's cost of daycare for my grandkids, and oh my gosh, it is expensive. It's, two grandkids sitting and going to a daycare takes up the salary of my daughter-in-law. And, sometimes you go, man, what am I doing? I'm just working to keep my kids in daycare. So, the benefit, there wasn't much benefit of having two kids in daycare and working full time. I can't imagine how some people do this at this time, that the cost of daycare has gone, through the roof, and, you know, keeping multiple kids in daycare full time is cost prohibitive. My daughter-in-law chose to stay home, with the kids. But where my son works, he was able to use the flexible spending account to pay for some of the daycare. There was a limit of 5,000, and now it's going up to 7,000. So, it's been expanded a little bit, maybe not enough for, the cost of daycare out there. I think this should be much higher so that they could use the flexible spending accounts, so that, they can put money away before tax to pay for daycare. I also think what they should have done is make it allowable to be rolled over, and not just, if you don't use it, you lose it. So, those are the kind of things that I think should happen. And in common sense, kind of like those health savings accounts, HSAs, hey, you can put money into it, not use it, and it rolls, for the future. And it even gives you investment options in that. And then it should be doing the same thing in these flexible savings accounts. Matter of fact, if you don't and you continue to roll it over, you should be able to convert it to something like a Roth or something, so that you could maybe do it for your children or do it for something for the future. But this flexible spending account through your employer, if they offer the plan, has moved the annual limits from 5,000 to 7,500. So, you're going to be able to take advantage of that. And the child and dependent care tax credit has also been expanded. Beginning in 2026, this year, the maximum rate increases from 35 to 50% of qualified expenses. So there are little other benefits to you if you do have children in dependent care. So take advantage of making sure that you get to use all those write-offs. Now, speaking of HSAs, health savings accounts, we've always had to ask, is, the plan you are on, is it eligible for health savings accounts? Now, if you're on like a Medishare plan, it's not eligible because it's not considered technically insurance. If you're on a plan that wasn't eligible for HSAs, you couldn't put money into an HSA. To look at HSAs, they're now available for marketplace plans. They're now available to you if you have a marketplace plan. To establish and fund an HSA, the individual or family must be enrolled in a high deductible health plan. And I haven't really seen anything that's considered to be really a low deductible health plan. I mean, if you can afford it and you have a low deductible plan, God bless you. I've seen the rates on these health plans through the marketplace. It used to be such that we could afford to carry health insurance for all of our employees. And then, of course, we got Obamacare, and all the rates went through the roof. I mean, you think about it, 15 years ago, we were paying only a couple $100s a month to have health insurance for each of our employees. And then now you're sitting here talking about $7,000-8,000 a month to have health insurance for your employees. Small business can't afford it. The employees couldn't afford it. And even if we were paying, we were paying a minimum of 50%. And at times when the plans were only a couple hundred a month, we were paying 100% of, their health plans. And then, as we saw these rates go through the roof, we could only afford to pay maybe 50% of it. And it was cheaper for some of them to go right through the marketplace. So we would then lose the number of eligible employees to get into an employer plan as such. So now if you've got a plan through the marketplace, beginning this year, the rule is modified to automatically include all bronze plans and catastrophic plans available through the Affordable Care Act or the Unaffordable Care Act marketplace. It expands access to HSAs for more individuals and families, and it can provide you with a deduction of up to $4,000 for self-coverage, $8,750 for family coverage. And then if you're over 55, you can contribute an extra $1,000. So it does give you that option. Now, if you haven't filed your taxes yet for 2025 and your plan qualified for an HSA, hey, you can still make that HSA contribution all the way up to April 15th. And you can go to like HSA Bank or someplace and set up your HSA account. And then you'll be able to get that deduction on your taxes as well. So there are some really good things in here that really will save you money. Now, something else that changed, limitations on applying gambling losses. Historically, the amount of gambling losses a taxpayer could realize was limited to their amount of winnings. But starting in 2026, the amount of gambling losses a taxpayer can apply against winnings is limited to 90% now, meaning someone who breaks even will still be subject to taxes on your gambling activity. For example, hey, if you won $10,000 and lost $10,000, you still have to report $1,000 as income on your tax return. Sorry, folks. They're looking for money. And I guess if you have the wherewithal to go and gamble that much, maybe you should be paying taxes. And I guess that's what they're thinking, even if you lost more. So if you won 10,000 and you lost 15,000 in that same event, you don't get a $5,000 loss. You don't even get to break even. You get to pay tax on $1,000. So, if they issued that statement of gambling winnings and they reported it to the IRS, hey, this is where you're going to lose on top of losing. Nobody said, hey, you're going to be a winner in taxes. You get to lose and then lose again. So IRS recently announced the changes and adjustments for more than 60 different tax provisions, including the tax rate schedules and other tax changes. You can go over to irs.gov and see all 60 of them. We're going to cover several of these changes and things that the IRS changed for rates, standard deduction, marginal tax rates, earned income tax credits, all that right after this quick break.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Hey, if you're a trucker, like we talked about at the opening of the show, you're looking for ways to save money on your taxes, especially for 2026. I mean, I wish we could go back and change things for 2025, but you're hard pressed to do that. We can, if you decide to come over to Trucker Tax Tools and work with us, and if we've got to go back and do bookkeeping for 2025, we're going to be looking for every deduction out there. So we're going to be looking for things that maybe you paid in your personal account for business. Look at every deduction that should be there, so that you can save money on taxes, because your fuel costs have gone to the roof, and it's time to find ways to save money. You should have been doing this years ago. Hey, but give us a call over at Trucker Tax Tools, or you can go to truckertaxtools.com and put in your information. But if you call us today at 877-996-2477, again, 877-996-2477, and tell them you heard it right here on Tax Talk for You. We got special discounts for you just for listening to this show. Come on in. Let's help you save money on taxes. Let's find every tax deduction that you have available to you that's allowed by law. You just get these pre-tax items and deducted, get the after-tax items moved to pre-tax, and save yourself money. And we're talking a significant amount of money. All right, so what's changed for 2026? What has the IRS done now? Well, usually this means they've increased items for inflation. So like the standard deduction. Standard deduction has increased for married couples filing jointly in 2026. So this will be the ones you file next year in 27 for the tax year 26. Standard deduction is increasing to $32,200. For single taxpayers, as well as married individuals filing separate, the 2026 standard deduction is increasing to $16,100. Head of household. If you're qualifying as a head of household, the standard deduction is going to be $24,150. So you're getting some inflation bump on those standard deductions. Now, for 2026, the marginal tax rates and the tax brackets are increasing as well. If you are a high earner, incomes greater than $640,000 or $768,700 for married filing jointly, your rates are 37% for every dollar above that. So when you talk about marginal tax brackets, means that if you are in the money you earn in this bracket is going to be taxed at this rate. So the 10% rate goes for individuals, single individuals with incomes of $12,400 or less, or $24,800. So every dollar you have below this as a joint family, $24,800, is only going to be taxed at the 10% rate. Now, if you move into the next rate and you have your income over $12,400 but under $50,400, that amount between the $12,401 and $50,400 is only subject to 12% tax. Now, for married couples, it's $24,800 all the way up to $100,800. So they're actually using doubling for the joint filers for these next lower brackets. So your next tax rate is 22%, and that's going to go from $50,401 all the way to $105,700. So if you fall into that bracket, the amount of money, the $55,000 are between the 50,400 and the 105,700 is only going to be taxed at 22%. And then married filing jointly, it goes from 108,000 to 211,400. So, kind of double, not bad. The 24 bracket goes all the way up to 201,775. And then above that is the 32% tax bracket. Now, if you're a married couple filing jointly, you go from that $211,401 all the way up to $403,550. Now, that 32% tax bracket starts at $256,000 for single. You would think that it's double. You would be right. It's $512,450, and that puts you into the 35% tax bracket, where you're going to be taxed 35% for the amount between $256,225 all the way up to $640,000 for single. That 35% tax bracket for married filing jointly goes from the $512,000 to $451 to $768,700. Was not doubled. Somebody missed the boat. So they feel a married filing joint couple now at that level is rich and gets to be taxed more than a single person. So, those are the hard parts that you go in here and you look at and you say, hey, what are we doing? How do these marginal tax brackets work? And it's just moving from one bracket to another. So when you look at your effective tax rate isn't going to be at the 22% or the 24%. It's going to be what was your tax at the 12% plus what was your tax at the 22% plus what was the tax at the 24%. And then you divide it by your adjusted gross income and you get your effective tax rate. So that's where you're going to say, hey, my effective tax rate is less than other people would have. A couple other changes that were done: earned income tax credit for 2026. The amount is $8,231 for qualifying taxpayers who have 3 or more qualifying children, and that's up from $8,046 for 2025. So you get a little bit of bump out there. Inflation hasn't been quite as high, so you get that little bit of bump. And those that are looking to give money, so annual gift exclusions for 2026, and this is giving money to family or friends and giving gifts to them, kind of passing money down maybe to your children. The annual exclusion for gifts remains at $19,000. However, the annual exclusion of gifts to a spouse who is not a citizen of the U.S. increased to $194,000 for calendar year 2026. That's up $4,000 from 2025. Don't know why they put that in there, but hey, it's there. So this is just some of these changes that you see from the one big beautiful bill. Hey, today's been a fun day, scrambling here and there, fixing internet problem, getting back on, getting on the phone, getting back on the computer. Hey, it's all the fun things we get to do sometimes when you're doing live radio, and you never know what's going to happen. But we do know what to expect from the one big beautiful bill and giving you bigger tax deductions. We're here every Monday, 10 a.m. Eastern time, here bringing tax information to you to help save you money on taxes. If you got a tax problem, reach out and call taxationsolutions.net at 888-930-1016. If you owe the IRS money going through an audit, hey, give us a call. Let us talk about what your tax problem is. Let us find ways to fix it in the no judgment zone, so that you know that you can get the best solution for you. Hey, as always, tune in right here Mondays, 10 a.m. Eastern Time on W4CY Radio at Tax Talk for You. Hey, don't miss an episode. You can like us on Facebook and it'll come up there, or go over to Tax Talk, the number 4, letter U.com. Follow us over there, and always be here Mondays, 10 a.m. Eastern Time. Hey, thanks for being here. Have a God-blessed and glorious week. Enjoy what you do and love your family. And we'll see you right here next week in Tax Talk for You.com on W4CY Radio. See you next week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at TaxTalkForYou.com. See you next week at W4CY.com.